Hello, everyone, and a very warm welcome to today's major markets update for Friday, May the 12th, 2023. Yes, I put up a high alert. I don't do it often, but there are a lot of charts that start to warn that we are going into a deeper decline before we see a rally. And I know these charts are still conditionally, but we are on high alert. This is code orange, so to say. Please trade it accordingly. Raise stops, take partial profits, hedge, whatever you do. And I don't say it lightly, but there's just a lot of things that are not giving me a warm, fuzzy feeling under the hood. I know price pays, and price is the final arbiter. And we might get all very bullish on how, for example, the NASDAQ and NASDAQ 100 are trading, but those are trading literally on 6 and 7 stocks higher. Yesterday, I looked at the BREF, and I literally knew it was the FANG stocks and Tesla that were up and everything else was down. It doesn't give me a warm, fuzzy feeling. Been there before. I might be wrong, but the charts will have to tell us. And I need to see definitely improving BREF, or else we're going to go to the lower levels before we see a better rally. I really would like to see some oversold conditions on the daily time frames to get better trade setups. So the S&P 500's price action this week is extremely overlapping and therefore hard to interpret. It's all over the map. Again, doesn't give me a warm, fuzzy feeling. We did hold 4,098. Okay, we missed break below it to target 4,081. Below that, we go to 4,050. Below that, we go to 4,300, which is the preferred path. We must break back above 41.45 to target 41.60, 41.70 before this flubber wave to continue. A flubber wave is 9 out of 10 times a B wave. However, we are down for the week, same as for the Dow Jones. I'm not even going to talk about the semiconductors or the Russell 2000. I don't see anything bullish about those charts whatsoever. So I'm not even going to cover them. The NASDAQ looks best as completing, in my humble opinion, a regular B wave of a larger flat. Remember, we were tracking 3 options. One was a standard impulse higher. We can take that one off the map because there is too much overlap going on. The other one was for a completing C wave with a final 5 waves higher. And the other one was for a completing B wave. Those were a little bit potato, pointing to about the same price levels for the upside. And my best guess is that we're completing a regular B wave of a larger flat. So below Tuesday's low, we'll confirm this thesis. Then 11,800 is the ideal target for the wave C of this flat. And then we can rally to 13,100. It does match better with seasonality as well. But please, let's not hang our hat on seasonality. Okay, it is simply a kind of a rough roadmap on what to expect, but we don't have to follow it at all. There are many ways that lead to Rome, and one of them is seasonality, but there can be many other ways to go about, and that is just an average of many years. So we're still above the 20-day to 200-day moving averages on the NASDAQ and above the Ichimoku cloud. That's bullish. However, MACD, RSI, MFI, they look tired, and so does market breadth. It's heavily negatively divergent. Again, it's a condition of a trigger, and this is what puts me on the high alert. It can always be erased. We only need 1 or 2 strong updates and it's all gone, but we must note it and we must take it into consideration in our trading decisions. For example, raising stop, taking partial profits, hedge, those type of things. We must take it into consideration. NASDAQ 100 is also overlapping. So the standard impulse higher is off the table. I have a hard time turning this into a 1-2, 1-2, 1-2 type of setup. I don't see it. It can still try for a last micro 5 higher on that wave degree of a ending diagonal to complete wave C/wave B. It's not necessary. Most of the time, we should not bank on a fifth wave. If we do get it, then the target is about 13,450, 13,510. So where did we close today? You kind of get an idea of how much upside is left, 13,340. So that's maybe 100 to 200 points left. That's it on 30,000. It's not much. So please consider the upside reward versus downside risk. If we break below 13,200, my own opinion, the top is it. Market breadth, again, is heavily divergent. I'm not the only one who's noticing it. I'll show other ones that I highly respect, putting it up and on their website for us to view, and one has to be pretty stupid to not take that into consideration. The Dow is still holding critical support at 33,120, 33,140, but it's below. If it goes below it, and especially below the May 4 low at 30,937, wave C is confirmed. So of all the 4 indexes covered in today's update, this index is really not looking the best. Quite the opposite, is looking the worst. So our preferred path, not the path, well, maybe the bulls are going to take a bath, a cold bath, of our B wave having completed this week, and now in wave C of this larger B wave that we're looking at. So the B wave, the larger B wave, will comprise of an A wave, a B wave, and a C wave, as B waves always and only comprise 3 waves. And we should now be in this C wave of that B wave. A, B, C is a B wave to about 32,000, 32,750. So this can be an ending diagonal. It's all going to be 3s overlapping. Crappy, wouldn't surprise me. But we must break below 33,120, and I would say 33,138, 140 to confirm this C of B lower. So that's where we're at. If you want to stop listening, then you have enough information, in my own opinion, to make appropriate decisions for next week. So here we go. I have a lot to cover. So this is the daily chart of the S&P 500. And as you can see, nothing has changed. The whole week's pretty much been sideways, slightly down. We have 1, 2, 3, 4, 5 trading days. We've gone nowhere. We're still holding the 20-day moving average just by, not actually, no, by, we're down below it by $1 or so. Preferred path is in blue. That's what I'm going to look for. Alternatively, and this requires a break above 41.95, is this 345. But I have a hard time seeing it right now, especially also with the Dow Jones really not confirming it and all the divergences that we're seeing right now. This is not a strong looking chart. As you can see, everything is on a sell. This is not on a buy. Heavy negative divergence. We're pretty much moving higher on less and less momentum. I know this month's high, or last month's high actually, was a little bit below the early January high. So it's not technically truly negative divergence, but you can kind of see the pattern. We're making lower highs in the MACD. We can even go back all the way to here to August, right? So this is a market that has waning momentum. This is a momentum indicator. It's a market with waning strength. It's a market with waning, I don't have it here, money flowing in. So it's still possible, but we need to see about 4195. Until then, I remain bearish, and this is the hourly chart. It looks super messy. Absolutely. Since Monday's high, this is all we've got this week. Good luck trading this. You got to have lightning fast fingers, or your trade will go sour, or you get whipsawed a lot. Now, we can still try for this wave C of wave B. It's possible, as you can see here. Why? Because it's so overlapping, it's hard to interpret. Below 4,098, clearly we target 4,051. Very, very simple. Now, if we break below 4,081, of course, we're going to go to 4,050. Very simple. And then below that, we're going to target somewhere between, I would say, 4,000 and 3,900. We'll have to get more price information to know. We go above 4,145, 41.45, and we can still target 41.60. But we're still stuck in this absolute nightmarish mess we've been in for soon 2 months, anywhere between this price level. So this is anybody's best guess. If you're making money in this market since then, you're doing great. Okay, you're doing absolutely great, because in sideways markets, it's very hard to make money. This is where you need very quick fingers. So remember, seasonality has a top and a low coming into late May, and from there we should then rally. So this seasonality matches with some of this market breadth things that I've seen, and it matches with the wave count, but we're not going to hang our hat on it, because this is just an average of 95 years, and there are probably years that are up, and there are probably years that are sideways. So it's just an average, but it is a guide, and as long as it works, it works. So here's then the NASDAQ, the regular NASDAQ. The price action we've seen all week is overlapping. It's nasty, and we have lots of negative divergence on the technical indicators. Okay, so we have slightest of positive divergence a little bit, so we can still squeeze out a last fifth of a fifth wave, as I mentioned in the summer. But look here, this doesn't look great at all. This is waning momentum. Also here, money is not following along with price. And liquidity is what drives it, all right? Liquidity is what pushes price higher. And that we see then in market breadth. So liquidity dries up the first in the smaller stocks. It moves into the big cap stocks, like the Apples, the Microsofts, the Googles, which have been pushing this market higher. And eventually, of course, the declining liquidity will also go into those large cap stocks that have been holding up the indexes, and that we get our drop. I would prefer to see us go back to 11,800 on the NASDAQ for this A, B, C path, a very long, drawn, flat correction. I love it. It would wrong foot many. Of course, we have to respect that we're above the 10, the 20, the 50, 200 day, and the cloud. Okay, but you can see this is not looking too great. NASDAQ 100, as you can see here as well, this rally is also overlapping weird. It's very hard for me to assign a true impulse on this rally. It looks more like a sort of ending diagonal wave C of B. We can still move higher. We're getting pretty close already to upside targets. Okay, this just looks awfully ugly. We still have a slightest of positive divergence, so to say. So we went higher on increased strength, but momentum is not there. And also money flow is not there. We need to see it turn down, can still move higher. But all of this is warning signs. We must respect we're above the 20, the 50, and the 200-day moving average, all of them are rising. So the trend is still bullish. So that we must respect. So shorter term, this was the wave count we were looking for, the 1, 2, 1, 2, 3, 4, 5 setup. Well, of course, with today's price action, I cannot make it into a 1, 2, 1, 2, 1, 2 setup anymore. This looks ugly. So what we're going to do with this one is we are simply going to put a big fat cross through it. This one is off the table. All right, save the changes. Yes, we're not going to look at this one anymore. We did not get a sustained breakout. It's just not working. This is not a 1, 2, 1, 2 setup. Bye. So then we have this option left, which matches with the NASDAQ I shared. 1, 2, 3, 4, 5 of a ending diagonal wave C of B, which would target somewhere around 13,450, 13,510. I'm wary of all the negative divergence also developing on the hourly. We must break below 13,200, which is the wave 2 low in this case, because wave 4, potential wave 4, cannot drop below wave 2. If we do, then this is dead. Then we're done, and we can start to look for 12,950, and below that we can target 12,600 to finally close that best gap. And that would then match quite nicely with this C wave. Alternatively, we already did complete the ending diagonal. Okay, we can count it 1, 2, 3, 4, 5. It is possible. Okay, 3 was not the shortest wave. It's fine. This is diagonally looking again below 13,200. Serious warning. This wave count is in play that we've completed this wave C / wave B. It's depending on how you count the overall bigger picture, but we should then of course look for a decline. Momentum is declining. We still have a little bit of strength here between May 8th and today. That's about it. But otherwise, it doesn't give me a warm, fuzzy feeling. But I need to see below 30,200 to give us a good idea that we have topped. So how about the Dow Jones? This is what we got all week. Nasty mess. We did get 5 up, and then we got this type of overlap lower. I don't even know how to wave count this price action since it's red wave B. So we've topped in this topping zone, and we've dropped. We did go below this ideal green B wave target zone, but we're holding 30,138. We're holding it. There is some positive divergence developing. So yes, we can still go back to make a more complex B wave, just as I showed you here for the S&P 500. So it is possible. I just cannot interpret any of this price action. I have no idea. Sorry about that, but we'll have to take it by price level. if we look at the daily chart, you can see we're holding the 50-day simple moving average. If we don't, we instantly will drop to the 200-day moving average into this wave B target zone where we have wave C of B. So this can turn into a ending diagonal. Okay, so this can be a wave 1, ABC wave 2, ABC wave 3, ABC wave 4, etc. type of down move. Wouldn't surprise me if that's the case. We topped here for wave B, and this is a weak looking chart from a technical indicator perspective. Nothing is on a buy, so it doesn't give me any warm, fuzzy feeling. The downside seems to be accelerating a little bit. So please keep it in mind. Below, of course, this A wave low, which is about 32,900 something. And then this wave C is full on confirmed. So those are the wave times. How are we doing on market breadth? This is the bullish percent index for the NASDAQ. It looks horrible, absolutely horrible. As you can see here, we're kind of moving higher and less stocks are participating, 36%. So that's pretty much the 6 big cap stocks, and that's it. Nothing else is running. So this is bad. It is a condition, can always be erased. Give it 5 good updates and we're done with this, but this is not looking healthy. I've pointed it out for a while. How are we doing on the AD line? This is the AD line for the NASDAQ 100. Ever since February, we're pretty much making lower highs. Can always be erased, but this is price here in green, and this is the AD line. AD line measures how many stocks are advancing and how many stocks are declining. And as you can see, less and less stocks are advancing. Again, we're moving towards the last ones standing, mega cap. Not looking healthy. And that has been captured as well by McClellan. Tom McClellan on May 5th, last week, showed this as well. And he also, of course, mentions that this is a condition, not a trigger, but as long as it persists, it must be taken into consideration. And it keeps on persisting. Ever since May 5, it keeps on persisting, getting worse, not getting any better. He then also, the week before that, shared the divergence between QQQs and the QQ equal weighted index. So the equal weighted index doesn't care about the relative influence of Apple on an index, which is of course a mega cap and has an outsized impact on a cap weighted index like the NASDAQ 100. So if you look at the equal weighted index, already on April 27, he started to notice negative divergence. Since then, we've moved higher, so you can really see this can last a long time before it matters. If we update that similar chart, QQQ here with the candles, and the line chart is the equal weighted index, you can see that again since February. Let's start here. All right, we'll start here. We have now this divergence continuing. So the equal weighted index is moving lower, whereas the regular index is moving higher, or in this case, ETF. Not a good sign. It means that if we do equal weighting, we're not looking healthy. On an even larger picture, you can see we're below the top here in late January. Meanwhile, price has moved higher. So overall, not a healthy looking sign. So please be aware, high alert. How we're doing on the new lows, those ones are slowly creeping up as well. Not necessarily massive peaks, but you can see that the average, even pointed out by the 50-day simple moving average of the equal weight new lows, is moving higher. So this is slowly deteriorating, even for the NASDAQ, slowly deteriorating. More and more new lows. I don't like it. It's not looking good. This will get updated later today. This is preliminary data. I'm sure we're going to move higher on this market breadth. How we're doing on the regular NYSE AD line. This is the best liquidity measure you can find. It's moving lower. It means less and less liquidity is available to drive prices higher. In fact, we have now topped in November 2021. And ever since, this is a large decline going on. This is moving lower. We have pretty much lower lows and lower highs. We have not seen such a long time frame between the all-time high and now since 2009. Every time we had a market correction within a year and a half, at the most, it would be over, and we are now well past that point. So this is unprecedented since 2009, telling us this is indeed not the bull market since 2009 anymore. Looks not good. Also pointed out by McClellan, actually, yesterday. Okay, so we start to see this divergence more and more. Can always be erased, must be noted. This is high alert stuff. Let me use the word stuff instead of the other one. How are we doing on the McClellan oscillator? Okay, yes, it's negative. Slightest of upticks today, fine, it's negative. More stocks are declining and advancing. Doesn't look too good. As such, the summation index remains on a sell as well. Also not in favor of the bulls until we see breakouts and reversals. How are we doing on how many stocks are above their 200-day and 50-day moving average in the S&P 500? Bull markets have kickoff waves well into the 80-90% for extended period of time, well above the long-term average, as you can see. That long-term average, by the way, topped here 2015 and has slowly been declining. Even the bull in 2020-21 had very high readings. Where are we now? 48. Less than half of the stocks in S&P 500 are above their 200-day moving average. Meanwhile, we kind of moved higher, less and less stocks participating, and we're well below the 200 of the long-term moving average. You see here, 2020-21, this is a bull market. Lots and lots of strength. And here, weakness. It's below. We just spiked a little bit above it here in January. Ew, this is not looking healthy. This is a warning sign. How are we doing on 50-day moving average? All right, we'll expand our criteria a little bit. Would you say 50-day? Well, this is all the data we have available since 2002. Unfortunately, it doesn't go back more than that. So it does make for a limited data set. But we can get a good idea of where things should be in bull markets. And as you can see, most of the time we stay above it, kickoff waves, that type of stuff, good breadth. And then these dips to almost zero are excellent buying opportunities. And we got those in 2022 twice. So those are the buying opportunities, and a little bit here below 20 earlier this year, and that's about it. But how are we doing currently? Do we have something similar, or is there strength? As you can see, we're below the declining long-term moving average. Less and less stocks are above their 50-day moving average long-term. That's not bullish. It's not. You can say all you want. That's not bullish. We had a little bit of spikes here, but nothing as sustained as we had, for example, here in 2020. Right? We're predominantly above the 50-day, the long-term moving average for the 50-day simple moving average. Less and less stocks, 47%. Less than half of the index has stocks above their 50-day. Less than half of the stocks on the S&P 500 are above the 200-day. This is just, weak. I don't like it. I'd like to see oversold. This was also presented by David Cox, who is not impressed to see the falling number of stocks in stage 2 uptrends. You don't necessarily know what stage 2 uptrends are, but as you can see here for the NASDAQ 100, less and less stocks participating in this rally, as we've seen before. So many people see the same thing. Warning signs galore. Please take it into consideration. Interestingly enough, we have a short-term buy signal since yesterday on the PMO Buy All Index. Interestingly enough, because it was on a down day for most indexes. Oh well, could be something like we saw here in December and something we saw here in February, March. This indicator is not perfect, but it must be acknowledged, and it is what it is. But we got some false signals here before we reversed lower. So that is really all I have for today. So I think the glass is half full at this stage. I would really need to see sustained breakouts above 41.95 for the S&P 500 to turn me bullish. And then we'll be looking for about, I would say, somewhere in the 4,300 zone. But if we see breakdowns, as I said, especially below these critical levels, 40.98, 40.81, 40.50, we're going to look much lower. I prefer that. It would match better with seasonality. It would match better with all the negative divergence we're seeing on all these breadth indicators. That just doesn't give me a warm, fuzzy feeling. But price pays, and so far price hasn't really responded much other than going pretty much sideways for the Dow Jones and the S&P 500. And slightly up for NASDAQ 100, but again, predominantly pushed by a few mega cap stocks. Take care, trade safe. See you all next week. Bye.